Well, hello again. I'm back again with my story about the European debt crisis that I'm using to be able to talk a little bit about government bond yields. Let me start out by reminding you, by summarizing a bit the story that I was telling you in the past video. Remember that I started out the video pretending that I was the Greek government, facing a deficit, needing to finance a deficit, and that I issued bonds at 4.5% to finance the deficit. And then I stopped being the Greek government and I started being a financial investor, a pension fund manager. And I was considering purchasing these bonds at 4.5%. And what was I thinking about? Well, I was thinking that I just had to make sure that the 4.5% adequately compensated me for these three factors: for opportunity cost, for expected inflation, and for counterparty risk. Okay, now let's say that, I'm looking at the 4.5% and I think that, it looks like a good idea. 4.5% looks like a good yield on the Greek bonds. And so I decide to purchase some of these bonds. Okay, so what do I do with these bonds? Let me remind you that bonds are just legal contracts. So I take these legal contracts that I've just purchased and I stick them in my safe. Okay, what am I going to do with them? Well, I'm waiting for 2018 when I'm supposed to get my money back. And in the meantime, time goes by. Time goes by, and 2008 is a terrible year. Okay, at the end of the summer, you have the banking sector that collapses. Here, let me go get my pen here. Okay, so, and let me maybe write in a different color. So maybe I'll write in green this time. Okay, so I have green here. You see right here, okay, at the end of the summer, what you see here, you see right here, you see all of a sudden the spreads opening up. So whereas before, all of the Eurozone governments in the legend are able to borrow on the capital markets at the same rate, well, when the banking system comes crashing down, you see that the markets start distinguishing between the specific different Eurozone countries. And namely, what you do see is that Greece starts facing higher interest rates than previously. Okay, so here we have, I'm going to write banking crisis. Okay, so banking crisis right there. Okay. Now, I was saying that the spreads opened up, okay, but nothing in comparison with what ultimately happens later on. Okay, so they just open up a bit, and then what you see is that things ultimately remain stable over the course of 2009. Okay, now we're at the end of 2009, beginning 2010, right here. Okay, so now we're sort of around there. And what happens? Let's say that I'm at home one night watching the news, and what do I hear? I hear that there's been a change of government in Greece. And it seems that the new government has just revealed that the old government hadn't been particularly precise in the reporting of the statistics regarding the public finances. And it would seem that the deficit is considerably higher than we had initially thought. Okay, so what were the initial thoughts? Okay, remember I started out the story by saying that yes, the government was spending more than it was collecting in taxes. There was a deficit. But the first numbers reported by the old government were close to 3%. Okay, so the deficit to begin with, so maybe I write that down, the deficit, spending minus taxes, was equal to more or less 3%. Okay, well, now we find out that it's considerably higher, actually 5 times higher, not 3%, but closer to 15%. Okay, so we're not talking about a small correction. We're talking about a pretty massive correction. Okay, and why is this important to me? Well, let me remind you, okay, I'm changing slides here. Let me remind you that the reason why I agreed to the 4.5% was because I thought that that adequately compensated me for the counterparty risk. I thought that the risk of a Greek default was relatively low. Now that I find out that the Greek deficit is considerably higher than I had initially thought, I realized that the 4.5% that I had agreed to doesn't properly compensate me for the true risk out there. So basically what I realized is I've made a bad investment. I've made a bad investment, so what I'd really like to do is I'd like to get rid of this investment. I'd like to sell my bonds. Okay, so I go to the market to sell my bonds. I was originally planning on selling my bonds for 100. You see, remember back in 2008, I purchased this paper for 100. We're only 2 years later, okay, right? We're here in 2010. And so I was sort of hoping that I could sell these bonds for 100. But when I get to the market, okay, what do I realize? I realize, well, everybody else has heard the news just like me, and everybody else has come to the same conclusions as me. And so everybody else is out there on the market selling their bonds, and that means that the price of the bond is dropping. Now, what does this mean for me? Okay, what does this mean for me? Well, let's take a look. Okay, let's first write out, okay, the deal that I had agreed to. Okay, so what did I agree to? I agreed, okay, to earning, this is supposed to be a period, €4.50 on a 100 euro investment. As we already said, I agreed to a 4.5% rate of return. Now I realize that that was too low. I shouldn't have agreed to it. I go out to the market and I'm selling, and I'm going to sell at a price that's less than 100. I'm going to sell at a price that's less than 100. Okay, let's say that I'm able to sell, okay, let me get blue here. I'm able to sell at, let's say at 70, okay, at 70. Now let's just think for 2 minutes about what I'm selling for 70. Okay, so I'm just going to go back up to the contract I signed where we have all the terms and conditions clearly spelled out. Okay, so I'm looking at this bond, and what does the bond say? The bond says that the Greek government has promised to pay the owner of the paper 100 euros in 2018. So this guy just spent, the investor that just purchased this bond from me, okay, just spent 70 euros to get the right to have 100 in 2018. Moreover, this investor has the right to 4.5%, not of the 70 they just paid for the bond, but of the 100 that's stipulated in the contract, 4.5% as a rate of return. So this investor is getting €4.50, okay, on a 70 euro investment. Okay, so it's a very different situation from the situation that I was facing. So this investor is getting €4.50 on a 70 euro investment. 4.5 euros divided by 70 euros, if I take my calculator, I see that it actually equals 6.4%. Okay, 6.4%. So I write that out. Okay, I'm not in the right place here. Okay, so 6.4%. Okay, so this investment makes sense to this investor because this investor is walking away with a higher rate of return. Now, it's this calculation that I just carried out that's mapped out in the graph here. Okay, you see how the yields are climbing very, very quickly? The reason why the yield is climbing quickly is because the price of the bond is collapsing. Okay, that's what's chasing, okay, this graph upwards. What's important to understand is that these bond yields, these interest rates that we're observing here, it's not the interest rate that the countries actually had to pay on the bonds. It's the price that they would have had to pay were they to borrow on the markets at those rates. But because these rates are so incredibly expensive, I mean, you see that Greece here in the middle of 2012 is hitting 30%. Because those are such high rates, they're absolutely unaffordable. Okay, and that's why Greece never actually borrowed on the market at those rates. Okay, so this is the rate that Greece would have had to pay if it were to borrow. Okay, and what's chasing those rates upwards, okay, is the fact that all of the investors are running away from the market, okay, and the price of the bond is collapsing. So as I just said, Greece never actually borrows on the markets at 30%. I just said that that was, completely unaffordable. Okay, so what happens? Well, basically, as soon as the rates hit roughly 10% here, you see that that's roughly sort of halfway through 2010, and that's about May. Basically, what happens is Greece needs money to be able to make certain payments. It turns to the capital markets. It sees this 10% that is absolutely unaffordable to Greece, okay, and it ends up in a situation where there's no way it could afford to borrow the sum that it needs, okay, and that's when the Europeans decide to bail out Greece. And what's a bailout? Well, a bailout is just providing the capital that's needed at lower than market rates. So the market rate in the middle of 2010 was 10 for Greece, okay, and the bailout, okay, was offering capital to Greece at lower than market rates. Okay, well, I think that I'm going to finish the video there. There's still more to tell about the graph, but that will then have to be in a different video.